Here is a question most investors never think to ask. What does a narrow stretch of water in the Middle East have to do with the price of silver sitting in your portfolio? The answer might surprise you, and it might change how you look at this market completely. Stay with me. Most people walking into a silver trade today are still thinking about it the wrong way. They see silver as a shiny metal, something you buy when the world feels uncertain, something your grandfather kept in a drawer. That mental picture is costing retail investors real money, because the silver market of 2024 and beyond is operating on an entirely different engine. Here is what the data actually shows. Industrial consumption of silver has been climbing steadily for years, and the Silver Institute's most recent figures confirmed that global industrial demand reached record levels. This is not a forecast. This is documented, measured consumption happening right now across multiple sectors simultaneously. Solar energy alone is consuming silver at a pace that was considered impossible just a decade ago. A single solar panel requires a meaningful quantity of silver paste to function, and the world installed over 400 gigawatts of new solar capacity in a single recent year. Multiply that across every panel, every installation, every country racing toward renewable energy targets, and you begin to understand the scale of demand that is already locked in before a single investor buys a single ounce. Then add electric vehicles. Every EV rolling off a production line today uses significantly more silver than a traditional combustion engine vehicle. Silver is embedded in battery management systems, charging infrastructure, and the electronic architecture that makes modern vehicles function. Global EV sales are projected to keep climbing aggressively through the rest of this decade. That demand is not optional. Manufacturers cannot substitute silver out of these systems without compromising performance and safety. Now layer on top of that the 5G infrastructure build-out, advanced medical imaging equipment, and semiconductor fabrication, all of which depend on silver's unique properties of electrical conductivity and thermal performance that no other metal replicates at scale with the same cost efficiency. What you end up with is a metal that the global economy is structurally dependent on across multiple high-growth industries at the exact same time. This is where it gets genuinely important for any investor paying attention. Supply has not kept pace. Silver mine production has remained relatively flat while demand has surged. The above-ground stockpiles that once acted as a buffer are thinning. When a commodity faces rising structural demand from multiple independent sources while supply stagnates, the price argument builds on its own, completely independent of speculation, sentiment, or headlines. That is the foundation underneath silver right now, and it is far more powerful than most people in this market currently appreciate. Here is something that most commodity investors completely overlook until it is already too late. The price of silver is not only decided in trading rooms or on futures exchanges. Sometimes it is decided in geography, in a specific stretch of water where the entire balance of global energy supply hangs on a thread. That place is the Strait of Hormuz, and right now it deserves far more attention from silver investors than it is currently receiving. The numbers alone should stop you. Approximately 20% of the world's entire daily oil supply passes through a waterway that is just 33 kilometers wide at its narrowest point. Think about that for a moment. 1/5 of global oil, the energy that powers manufacturing, transportation, mining, and industrial output across every major economy, moves through a corridor so narrow that a serious disruption there does not stay regional. It goes global within days. Energy markets respond immediately, and everything connected to energy costs follows right behind. Silver mining is deeply connected to energy costs. Open pit and underground mining operations run on diesel, heavy equipment drilling systems, or processing facilities, and transportation logistics all consume significant amounts of fuel. When oil prices spike due to Hormuz tension, the operating cost structure of silver mines changes overnight. Margins compress, some producers reduce output, planned expansions get delayed. The metal that was already facing a supply deficit now faces additional production pressure from the cost side simultaneously, and the market has to reprice to reflect that new reality. But the Hormuz effect moves beyond just production economics. When tension escalates in that region, it triggers something measurable in global financial behavior. Risk sentiment shifts. Institutional capital that was allocated to equities or growth assets begins rotating toward hard assets and commodities as a hedge against broader instability. This rotation does not happen in a straight line, and it does not happen overnight, but the direction is consistent, and the historical data supports it clearly across multiple episodes of Gulf tension over the past 3 decades. What makes this particularly relevant today is that the current geopolitical environment around the Strait of Hormuz is not a background risk anymore. It is an active, developing situation with real economic consequences already visible in energy pricing. Silver investors who understand this connection are not reacting to headlines. They are positioned ahead of a supply and sentiment shift that the broader market has not yet fully priced in, and that gap between current pricing and fundamental reality is exactly where serious opportunity lies. If you have been in financial markets long enough, you learn one lesson that never changes regardless of the decade, the technology, or the economic cycle. When the world feels genuinely unsafe, capital moves toward hard assets, and it moves fast. This is not a theory. It is one of the most repeatedly confirmed behavioral patterns in the entire history of modern finance, and silver sits right at the center of it every single time. Cast your mind back to 2019. Gulf tensions escalated sharply following attacks on oil tankers and Saudi Arabian energy infrastructure. Within weeks, silver moved decisively higher. Investors who understood the connection between regional instability and precious metal flows were already positioned. Those who waited for the financial media to explain the relationship bought into strength and paid a higher price. The same pattern repeated with even more clarity in early 2022 when the Russia-Ukraine conflict escalated into full-scale war. Silver and gold both spiked as institutional and retail capital simultaneously sought the protection that hard assets have provided through centuries of human conflict and economic disruption. What makes silver particularly compelling in these geopolitical stress episodes compared to gold is a dynamic that most casual observers miss entirely. Gold is the established safe haven. Everyone knows it, everyone watches it, and because of that, it is already priced with a significant risk premium baked in during periods of elevated global tension. Silver starts from a structurally lower price base and carries a dual identity. It is both a monetary metal and an industrial one. That dual nature means it attracts two separate streams of demand simultaneously when stress hits. Safe haven buyers come in from one direction while industrial demand continues, providing a floor from the other. The combination creates a more powerful percentage move than gold typically delivers in the same environment. There is also a ratio that experienced precious metals investors track closely: the gold to silver ratio. Historically, this ratio has averaged somewhere between 50 and 60 over long periods, meaning 1 ounce of gold buys between 50 and 60 ounces of silver. When geopolitical stress drives gold sharply higher and silver lags in the initial move, that ratio stretches well above its historical average. What follows historically is a mean reversion where silver closes the gap aggressively, often delivering outsized percentage returns relative to gold over the following weeks and months. The current geopolitical environment is not a single isolated event. It is a convergence of multiple stress points across different regions, with Hormuz sitting at the center of the most energy-sensitive pressure zone on the planet. Capital responding to that environment has a well-documented historical destination, and silver is on that map. There is a moment in every major commodity move that serious traders recognize in hindsight and wish they had recognized in real time. It is the quiet period just before the breakout, when price is going nowhere obvious, volume is building underneath, and the majority of market participants have lost interest or moved on to something more immediately exciting. That period of apparent stillness is not weakness. It is accumulation. And right now, silver's technical chart is displaying exactly that structure with a clarity that demands attention from anyone who understands how markets actually move. Price compression is one of the most reliable concepts in technical analysis precisely because it reflects something real happening beneath the surface. When a market consolidates in a tight range for an extended period, it means buyers and sellers have reached a temporary equilibrium. But equilibrium in a market facing the kind of fundamental pressure silver is currently under: supply constraints, rising industrial demand, geopolitical stress, and currency headwinds, is not a neutral condition. It is a coiled spring. The energy does not dissipate during consolidation. It builds. And when the balance finally shifts, the release is proportional to how long and how tight the compression has been. Look specifically at what silver's chart has been communicating. Repeated tests of overhead resistance without a meaningful breakdown on the downside is a technically significant signal. In classical chart analysis, every failed attempt to push price lower actually strengthens the floor beneath it. Each time sellers attempt to drive silver down and fail, it confirms that buying interest at those levels is genuine and persistent. Meanwhile, the volume profile building underneath price during this consolidation period tells a story about who is participating: patient, conviction-based accumulation rather than short-term speculative trading that evaporates at the first sign of volatility. What makes this technical setup particularly relevant is the time frame of the consolidation. Short compressions produce modest moves. Extended compressions built over months, tested multiple times, and supported by genuine fundamental drivers produce the kind of breakouts that redefine a market's price range for an extended period. Silver's current structure falls into that second category. The duration of the consolidation, combined with the fundamental backdrop behind it, creates a probability environment that experienced technical traders take seriously, regardless of their view on the underlying commodity. The market does not ring a bell at the bottom or send an announcement before a breakout begins. It leaves fingerprints in the price structure for those who know how to read them, and right now those fingerprints are visible across silver's chart in a pattern that historically has preceded some of the most significant moves this metal has ever produced. There is a financial relationship that most retail investors never fully appreciate until they watch it play out in real time and realize silver's the entire move. It is the relationship between currency, purchasing power, and hard asset pricing. And right now, that relationship is sending a signal about silver that cannot be ignored by anyone paying honest attention to the macroeconomic environment. Start with the dollar. The United States federal debt has crossed $34 trillion and continues climbing at a pace that has no historical precedent in peacetime. The Federal Reserve spent years telling markets that inflation was transitory, then spent the following period raising rates more aggressively than any cycle in recent decades, trying to contain what they initially dismissed. The credibility cost of that sequence is real, and it is measurable. When a central bank loses forward guidance credibility, the currency it manages begins to price in a risk premium that was not there before, and that premium shows up most clearly in the performance of hard assets relative to paper currency over time. Here is the practical mechanism that connects dollar weakness directly to silver pricing. Silver is denominated and traded globally in US dollars. When the purchasing power of the dollar declines, it takes more dollars to buy the same ounce of silver, even before any change in the underlying supply and demand dynamics of the metal itself. This means currency depreciation acts as an independent price driver for silver that sits entirely outside of industrial demand or geopolitical risk. It is an additional layer of upward pressure that compounds the fundamental case rather than replacing it. What makes silver more compelling than gold in a dollar weakness environment comes down to mathematics and starting position. Gold at current levels requires a substantial move in absolute dollar terms to deliver meaningful percentage returns. Silver, trading at a fraction of gold's price, delivers those same percentage returns from a significantly lower base. When institutional money rotates into precious metals during a dollar weakness cycle, the percentage gains in silver historically exceed those in gold, not because silver is more important, but because the math of percentage movement from a lower price base is more powerful. The current environment has persistent inflation running above the Federal Reserve's stated target, a debt trajectory that independent economists describe as genuinely unsustainable without meaningful dollar debasement, and a geopolitical landscape that is reducing global appetite for dollar-denominated assets among major foreign holders. Each of these factors individually would be worth noting. Together, they create a macro backdrop for silver that is arguably stronger than anything this market has seen in over a decade. There is a reason why the investors who consistently build wealth in commodity markets are rarely the ones you see reacting to breaking news or chasing price after a major move has already happened. They are the ones who were already sitting quietly in position while everyone else was still asking whether the opportunity was real. Understanding how institutional money actually moves, and more importantly, when it moves, is one of the most valuable frameworks any serious investor can develop, and silver's current setup is a masterclass in exactly that dynamic. Institutional capital does not operate on the same information timeline that retail investors assume. Large funds, commodity trading advisors, and macro hedge funds are not reading the same headlines at the same time as the general public and then deciding what to do. They are running systematic screening processes that identify multi-factor convergence, situations where several independent fundamental drivers are aligning simultaneously toward the same directional outcome. Single-factor trades are common and generally produce modest results. Multi-factor convergence trades are rare, and when they appear with the kind of clarity currently visible in silver, they attract serious, patient, conviction-based capital that does not exit on the first sign of noise. Consider what the institutional checklist looks like against silver's current environment: industrial demand growing at a documented, structural pace. Confirmed. Supply constraints tightening due to flat mine production and declining above ground stockpiles. Confirmed. Geopolitical pressure on a critical energy choke point, creating both cost side and sentiment side upward pressure. Confirmed. Technical price compression building over an extended consolidation period with volume accumulation underneath. Confirmed. Dollar purchasing power under genuine macroeconomic stress with debt and inflation dynamics that are structurally bullish for hard assets. Confirmed. 5 independent factors, all pointing in the same direction, all confirmed by data rather than opinion. When a setup like this develops, institutional positioning typically begins well before any mainstream financial narrative forms around it. The price action during accumulation phases is deliberately unremarkable. That is partly the point. Large positions cannot be built efficiently in a market that is already moving and attracting attention. The quiet consolidation that frustrates retail investors watching silver go nowhere is often the exact environment in which the most significant positioning is taking place beneath the surface of the visible price action. By the time silver appears as a trending topic on financial media, features in mainstream investment publications, and becomes the subject of widespread retail enthusiasm, the foundational move will already be substantially complete. The investors who understand the connection between Hormuz, industrial demand, technical structure, currency dynamics, and institutional behavior are not waiting for permission from a headline. They are already there, and that is precisely what separates informed market participation from expensive reaction. So when you see a headline about the Strait of Hormuz, don't just read it as an oil story. Read it as a silver story. Read it as a supply story, an energy story, a safe haven story, and a technical breakout story all in one. The investors who make generational returns from commodity moves are not lucky. They are informed. They understand the connections that the average person misses. Silver's next major move may already be in motion beneath the surface. The only question is whether you understand why before the rest of the market catches up.